Hello everyone, welcome to Demand Supply Trading Practical Session number 33 for the year 2025. Myself, Surjit Kakkar, and today is Sunday, 31st of August 2025. And before we get started with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you related to content. With content related to demand supply trading methodology. Plus, we also update you when these live sessions are scheduled. So in case you have still not joined this channel, you wish to join it, there are a few different ways you can do it. The first and foremost is you can scan the QR code, which is on your screen. You can also go to the description of this video. That is where you'll be able to find the direct link. And the last way is that when you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you are on our website, what you can do is you can just scroll down on any of the pages to the footer section. And here you can see you have the option which says join the Telegram channel and the join now button. You can simply click on it and you can be part of this channel. All right, so that being said, and let's move ahead. So today's session is all about practical application of demand supply trading methodology. So every weekend I do a practical session where we apply the complete methodology to some examples so that you people can learn how to implement the methodology in real life. Now, the demand supply course used to be a paid course, but now it is available as a 100% free course. And when you go through the course, you basically learn the methodology theoretically and how to implement that theory in real life. That is what we do in these sessions. Now, the best part about these sessions is that we are not analyzing something which has already happened because, like I always say, that's a piece of cake. A move which has already happened, it's very easy to justify it. You can use a number of indicators, oscillators, or maybe even price action, and you can justify that move. But the real beauty lies when you're doing the analysis in advance. And that also helps you build confidence in the methodology, because when I'm doing the analysis in advance, none of us know what is going to happen in the future. So you are seeing the before, and whatever examples I share with you, whenever they get triggered in the future, we also review them. So you're also able to see the after as well. So what happens is you get to see the both before as well as the after, and that helps you build confidence in the methodology. And this is also the reason why demand supply is also called as a set and forget methodology, because things can be pre-planned. So it's not that during the live market only you're waiting for a signal to happen. You can always pre-plan and be ready with your setups, and whenever the prices they enter into your areas of demand and supply, that is the time you can participate in those trades. All right, so to be comfortable with these sessions, there are some prerequisites, and completing these prerequisites will definitely help you. So let's understand what these prerequisites are. The very first one is the Trading Essentials course, optional for someone who already has a very good trading background, very good trading experience. Though I would highly recommend, irrespective what your trading background has been, everyone should start with our Trading Essentials course. Now, how do you access the Trading Essentials course? Very simple. Once you're on our website, under services, go to courses. And this is where you can see all our courses are listed. The very first one is Trading Essentials. Click on it. It is available in 2 languages, English and Hindi. So whatever language you're comfortable with, you can click on it. No signups required, no registration required. Once you click on this, you'll get immediate access to the playlist. All the lessons are laid out for you. Lesson 1, lesson 2, lesson 3. Complete all the lessons. And once you complete all the lessons, that basically takes care of your Trading Essentials course. Now, once you're done with Trading Essentials, the next step is to learn the demand supply trading methodology. So again, under services, when you go to courses, you can see the second one is your demand supply trading course. Click on it. And this is also available in both languages, English and Hindi. So whatever language you're comfortable, you can click on that. Again, it will be presented to you as a playlist. You have lesson 1, lesson 2, lesson 3. Go through all the lessons, and that basically covers your your demand supply trading course theoretically. Now, once you have done the course theoretically, like I said, you also need to see some practical examples. So for that, you have 2 options. Option number 1, like I already said, I do these practical sessions almost every other weekend. So you can always join these live sessions. And the beauty of these live sessions is that if you have any questions, queries related to demand supply, you can also put it in the chat box. Like I can see today, we have quite a few questions already lined up in the chat box. I will be answering these questions, but we always do it at the end of the session. You can always put in your questions, queries in the chat. Plus, if you want to watch more number of practical sessions, you can also click on this practical sessions. So what we do is whatever practical sessions I take, we also keep an archive of it so that you can always revisit those sessions over and over again. And what happens is that in just one single session, we can't cover every aspect. So the more number of practical sessions you will see, the better you will start having the understanding of the methodology. And these practical sessions are also available in both languages, English and Hindi. So whatever language you're comfortable with, you can click on it. You can access the archive. Currently, the archive is close to almost 2 years of recordings that is available to you. So again, the more number of practical sessions you will see, the better you'll start having the understanding of the methodology. Now, during the live sessions, you will also see that I use two documents, which is the rulebook and the flowchart, and they help us plan trades very mechanically and rule-based. Now, how can you download these documents? Again, very simple. On our website under services, you have the option for downloads. And here you can see the first one is your rulebook. You can download it. Second one is your flowchart. You can download it. So this is your flowchart. This tells us step by step what we need to do as a demand and supply trader, and you'll also see it in action during today's session. And this is your rule book, which is basically a conservative approach, but with time, with experience, if you want to modify it based on your personality style, those modifications can definitely be done, but at least you do have a starting point using which you can start planning your trades. Now, before we start with today's example, we also have some examples which are getting carried forward from the past, and we also have one which got triggered this week. So let's review those examples and then we'll continue with our session for today. So the very first one is, just give me a second, let me bring it up. Right. So the very first one is this one. So this is from session number 25. We did the analysis on the 22nd of June, and the prices came into the zone on the 28th of July. So we have been carrying forward for the last X number of weeks. We haven't got the exit on this as of now. And if I say all demand supply structures, you can see now we do have some areas of supply which got formed. But the thing is, I guess we were planning this trade at the best location. So at best location, yeah, so we were at the best location. So at best location, what happens is that if your lower time frame does not show you good RR, you can always take it from the intermediate time frame. Plus, I didn't realize, you can see we also have a formation of a monthly zone by the end of the previous month, right? So things would have changed. But anyways, if these supplies they get violated and we have formation of some new demand areas, we can trail onto it. As of now, we have not got the opportunity to trail onto it, so this will still remain as an open trade. But like I already said, because we had formation of these new areas and we also have a monthly supply now, if you wanted to exit with a small little profit, this could have been done. Because see, what I do is in these sessions, I try to quickly review them. At times, you know, I might not go to different time frames, but I just saw it today that on the monthly also we had a formation of a zone. So it would have definitely made more sense that when this zone was formed, we could have taken an exit with a small little profit. But let's still keep it as an open trade. We'll see how this one continues. Now, the next one is, give me a second, from session number 20. So just give me a second. Let's go to session number 20. So this was from our session 20. The session was on the 18th of May. We came into the zone on the 30th of July. So here also you can see when we came into the zone, we had formation of the supply area, which is a drop-based drop. And at the time of entry, this would have been fresh, which is only showing us the reward to risk ratio a little over maybe 1.5, 1.6. So whatever target it was showing us, it has already achieved that target multiple times. But the thing is, we don't take trades for such small reward to risk ratios. We always look for at least 2:1, but let's see where were we located. So when we were planning the trade, we were not very low on the curve. You can see our entry price was still low on the curve. So here also it definitely made sense that either because of the reward to risk ratio we could have skipped, or if you wanted to trade for this 1.5, 1.6, that could have been done. But yes, we'll still keep it as an open trade. We'll track it for the next few sessions. But yes, wherever the target it was showing us, it has already hit that target multiple number of times. All right, now the next one is your session number 22, right? So just give me a second. Let me bring that up. Session number 22. So this is from session number 22. We already got a move which was about close to 2:1. So we got the opportunity to make it as a break-even trade. But again, at the time of entry, this would have already been tested. So this is also tested. So anyhow, we don't use tested zones for our targets. So we didn't have any fresh areas. But let's also see where we are located. So this one, we are located definitely very low on the curve, and the same thing, you know, we have a formation of a monthly zone when this candle completed. So yes, a few challenges with these trades. And if you look at the weekly chart for the reward to risk ratio, since we are at the best location, we don't have any zones anywhere close by. So what we'll do is we'll still keep it as an open trade. We haven't got the opportunity to trail onto it as well. Prices have already tested the demand zone multiple times, but yes, whatever the zones were, they were tested zones. But yes, there are a few challenges now because of the formation of the monthly zone that we have on this one as well. All right, so that takes care of session number 22 example, which was getting carried forward for us. And let's now look at the last one. Give me a second. So this one got triggered during this week. We did the analysis the last session for this one. So let's look into this one as well. Perfect. So this one, when we did the analysis, again, we were not at the best location. So here you can see when the prices, they started coming back into the zone, we had this supply, but this was already tested. So again, if you talk about your target, we will be looking for a fresh zone, and we don't have any fresh zones anywhere close by. So this was still an acceptable trade because reward to risk ratio was not a challenge. And we were not at the best location on this one. You can see we were a little outside of the zone, which makes our location as low of the curve. So here we definitely required the reward to risk ratio in the lower time frame. But now the challenge is we also have a formation of a zone inside of our demand area. Now, what do we do in such case? You know, the fact is, when we did the analysis, we also saw that this was also a weekly zone. So since this was also a weekly zone, I'm not very much concerned about this. But if this was not a coinciding level, then I would have said maybe it would make sense to close our position. The reason is because we have a formation of a supply, and if you have a formation of a supply, and due to this, if the prices they further start moving down, it is better to exit with a smaller loss versus taking maybe a bigger loss, right? But since this is also a coinciding level, which means that this is also a weekly zone, I'm still comfortable holding this. That is what we'll do. So we'll keep this one as an open trade as well, and we'll track it for the next few sessions, and unless and until we get the exit on this one. So that basically covers the examples which were getting carried forward, plus also the example which got triggered for this week. Now let's get started with our today's example. So just give me a minute. Let me set this up, and then we'll start with today's example. All right. Perfect. So let's get started. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. The link is available in the description. In case you have not yet watched that video, do ensure you watch it, understand the process, follow that process. You might have to do it twice, you might have to do it thrice, but there is no bypassing it. So the sooner you start with the process, the better it is going to be for your trades, and the more it will make you a rule-based trader versus an emotion-based trader. So since we need to be mechanical and rule-based, we need to create something which is called as a trade plan. Now, the challenge is when you start learning trading or you start learning a new methodology, it is not very easy to create a trade plan from day one. So that is where these documents that I have created for you, they help you. So you do have a starting point available to you, which, like I already said, is a conservative approach. But as you start having more and more experience with the methodology, you want to make any modifications to it to make it better suit your personality style, those modifications can definitely be done. So what is my step number one whenever we start planning our trade? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, exit can be the trailing stop loss, it can also be the stop loss, any kind of exit. So now the question comes that why are we starting with the trade purpose as our very first step? And the reason we are doing this is because when we do the analysis, the charts that we use, they are time-based charts. Just give me a second. Right, so they are time-based charts and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so let's say we are taking example of the Indian NSE market, it's not a 24-hour market. So I'm pretty sure all of you would have experienced that whenever this market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24-hour market, we have that gap risk which is added to that particular position. So this is why my recommendation to all of you would be that initially your hourlies and dailies will be strictly intraday trades. We don't want to keep them as overnight trades and take unnecessary gap risk. Weeklies and monthlies, here we have no choice. We'll have to keep them as overnight trades because we are not expecting the exit the same day. But that does not mean that for weekly monthlies we cannot have gap against us. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. But it is still possible that for weekly monthlies we might get gap against us. So again, initially hourly dailies, strictly intraday, weekly monthlies, overnight. With time, with experience, you want to include daily incomes into overnight. That can be done. And my step 1 was I need to define my trade purpose. Let's assume I opted. I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, like different kind of entries. And in case you need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? You get the answer from this table. Now mind it, this table which is on page number 31 is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, let's say some international markets, cryptocurrencies, then you can look into the table which is on page number 32. Since I'll be taking examples from the NSE, I will be following this table. And because I opted, I want to plan monthly income trades. From here, I got to know that my time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes, like fine-tuning the zone, type 2, type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I take example of NSE, on NSE I have over 2000 companies listed. So it's not humanly possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place which can help me get a smaller list out of a very big list of symbols. Because if I have a smaller list, I can do my analysis almost every other day. But if I have to go through 2000 symbols every day, not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And if you'll do a Google search, you'll be able to find a number of free scanners, a number of free screeners, which are based on conventional technical analysis or fundamental analysis. Now, there were no scanner screeners which were built on purely demand supply trading methodology. So that is where we also created two custom built tools. One is called as the demand supply zone alerts, and the other one is called as the demand supply zone screener. So if you'll click on these, it will take you to our product page where you can find the walkthrough videos that will help you understand these tools in depth. I'll also tell you how you can do that from our website. So once you are on our website, give me a second, you can always go to services, trading view indicators, and here you can see that you have the alerts and the screener. So click on subscribe now. It will take you to the product pages, which is where the walkthrough videos are available, and those walkthrough videos will help you understand these tools in depth. But I'll quickly brief you what these tools are. So if you talk about alerts, so this is what alerts they do. Can you see we got these alerts during the live session, because as of now only the crypto market is live, so I have placed these alerts on the cryptos. So here you can see that it is telling me, because currently I'm on the 5 minutes time frame, it is telling me that if I go to BTC USD, we'll have a formation of a zone on the 5 minutes chart. So if I go to BTC USDT, and let's change this to crypto. So we have a rally-based rally. Can you see that is what it told us? We have a rally-based rally starting at 10,866.16, ending at 10,864.3. So you might say it's not a quality area. The reason is I have currently placed the alerts for all structures, be that quality, be that not quality, so that at least I can show you some examples during the live session. So this is what happens, that as and when you have formation of these demand supply areas, it keeps updating you. Now, if you have a free TradingView account, at least you'll get these notifications on your chart. But if you have a paid TradingView account, you can also place your alerts so that you get those notifications. So in case we get some notifications during the session, I'll show you examples. So can you see we just got a notification? So this is how it works. So can you see it is telling me that if I go to the first one, which is XPR USDT, XRP, my bad, XRP USDT, you'll have a formation of a zone. In fact, I think I'll have to change this to, I need to update to the latest version, and I also need to change this to all demand supply structures. So did I open the incorrect? So let's see, it's XRP USDT Binance. I'm on a, okay, let me just see the ADA US. Perfect. So here you can see we have a formation of a zone. I'll have to check the first one, why it showed the first one, but it was not on the chart. But here you can see the second one. We have the notification, we have the zone on the chart. If I go to the next one, SUIU. So here also you can see we have a formation of a zone, and as soon as the zone was formed, we got the notification, which was again for a rally-based drop. So this is what alerts they do. As and when the zones are getting formed during the live market, they keep updating you. If you talk about the screener, now this is how the screener works. So let's go to the daily time frame. So in the screener, again, I've given my list of symbols, and I've also given my proximity setting as 2%. So when the current candle will be within 2% to a demand area or a supply area, it gets shortlisted for us. So here you can see it is telling us that for TCS, I have proximity to demand. So if I go to TCS, you will see that we'll have a demand zone and we have proximity to it. Now, the reason it is not showing to supply is because I have said that I don't want tested areas. If I enable tested areas, it might also show for supply if it is within 2%. So let's wait for it to refresh. So this will not be within 2%. That's why it is not giving for the supply. But you can see if I check from here, we are within 1.7%. So we are within 2%. That is why it got shortlisted for us. Similarly, if I go to infy, you will see infy will have proximity to both demand as well as supply, INFY. So here you can see we have proximity to both demand as well as supply. And similarly, if I go to Bajaj Finance, so what you can see is that what Screener is doing is that if I've given a list of 15 symbols, I don't have to analyze all 15. It is telling me out of these, you can only check these 3. And similarly, you can give your list by using the indicator multiple times on multiple charts, and you can have as big as an array of symbols available to you. Definitely the limitation is if you have a free account, then you will have to change the symbol list here, but you don't have to change it manually for each of this. You can always copy paste your CSVs here. So once you go through that video, which is the walkthrough, that will help you understand how the process can be done much more faster. All right, so that's your alerts and screener. So now you have a brief understanding. So what alerts is doing is that as soon as you have a formation of a demand area or a supply area, during the live market, it updates you. And screener, when the current candle is within that proximity range to a demand zone or a supply zone, it updates the table on the chart, and you get to know on which symbols I'm getting closer to demand areas or closer to supply areas, right? So that's the difference between the two. So again, step 2 is to get a smaller list. How you get that small list is completely your choice, but always remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols. The job of the scanner screener is not to tell you what you need to buy or sell. The job is to give you a smaller list, which then you need to analyze manually, and whatever is in sync with your trade plan might be an opportunity for you. Whatever doesn't qualify based on your trade plan, it has no meaning for you. And the process can also be as simple as I just want to go through my Nifty 50 stocks, or I have my own favorite list of symbols which I want to analyze. The choice is yours how you want to get that small list. But once you have that small list, like I said, we need to go through these one by one. So let's assume the very first one was ABC. So I need to go to the lower time frame on ABC and identify zone. Now, the good news is even for identifying these demand and supply areas, we have a tool which is called as demand supply zone indicator, which automates the process that you don't have to find the zones now. It will automatically do it for you. And we also provide a 100% free 7-day trial of that indicator. So in case you have still not taken the trial, the direct link is in the description. Otherwise, once you visit our website, you will get a pop-up on the top. But let's assume that you've already closed it. Then you can always go into services, trading view indicators, and then you have the demand supply zone indicator. Click on it and you'll find this button which says 7 days free trial. A very short form. You just have to provide your full name, your email address, and your TradingView username. In case you don't have a TradingView account, you can click here, create a free TradingView account, provide your username. In case you already have a TradingView account, you can click here, visit your TradingView profile, and provide your TradingView username. And this will tell you when your subscription will expire. How did you hear about us? Choose the relevant option. Click on I'm not a robot and finish and start your free trial. Once you fill this form, in about 24 hours, the indicator will get activated for you. And then you'll also receive a notification on TradingView that now your access to the indicator is active. And then you can start utilizing that indicator for free for 7 days. So since everyone can now have access to the indicator for at least 7 days, I'll do the analysis purely based on the indicator. So here you can see I have already applied the indicator, and it is telling me that we have one demand zone which is right here. We have another demand zone which is right here. We also have a demand zone which is right here, but it is already tested. So let's forget about a tested zone. Let's start with something which is fresh. So we have a rally-based rally. So I'll mark this rally-based rally. In fact, let me do this. Is session number 33. Let me mark it as 33 and let's save it. All right, so we have this zone available. So our step number 3 was to identify a zone. Do we have a zone available? The answer is yes. Now, once you have identified the zone, doesn't mean you can trade it blindly. The next step is to qualify it, for which we have a 2-step process. In step 1, we'll qualify based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the first one is, can this zone be a case of level on top of level? Now, how do we verify that? Very simple concept. If you have an intermediate time frame zone and the same zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, it is called as a case of level on top of level. So what this tells us is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it can be a case of level on top of level, but if you don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And on the intermediate time frame, you can see we do have a demand area here, which is this rally base rally. Now, like I've said in the past as well, that if you want to be more aggressive, right? If you want to be more aggressive, you can say that the zone is always from the basing. So I want the basing of both the intermediate and the lower time frame to be common. In this case, you can see a little bit, it is a little bit outside, right? So again, if you want to be aggressive, you can say I want this to be completely inside of, I want the lower time frame zone to be completely inside of the intermediate based on the basing, because basing is where we draw the zone. But if you talk about the zone, a zone is always made up of 3 components, which is your leg in, your basing, and your leg out. So if I take all the 3 components, which is this leg in, this is my basing, and this is my leg out, we still have a zone which is partially on the leg out, right? It is partially on the leg out. It's not that it's on the other candle. So if you want to be a little conservative, you can say, okay, since it is still part of the leg out, let me consider it as a coinciding level, and I want to plan my trade more conservatively. Absolutely acceptable, nothing wrong with that. And in such case, what we can do is, if I go back, you can see we have one zone which is right here, and we also have another zone which is just right below it, and both these zones are now inside of my intermediate time frame zone. So that's the second one. And since it is not mandatory that for your cases of level on top of level, all zones might be quality, let me also take all demand supply structures. So you can see we only have 2 structures which are inside of it. So basically, as a conservative trader, I can call it as a case of level on top of level, and due to which what I would prefer to do is I would prefer to shift to the lower zone. Plus, I would also like to have my distal line from the distal line of the intermediate time frame zone, right? So a small little modification. So what we have done is we have fine-tuned our entry a little deeper into this intermediate, and we have also placed our stop loss based on the intermediate time frame. So that's the way I would prefer to participate in this one. Yes, it has its own pros and cons. The pro side is definitely now my zone is much more refined, and also a stop loss which is at a better location. But the downside is we might miss the trade, right? That can also happen. But again, like I always say, different traders, different personality styles. I like to be on the conservative side. I know it is at the cost of missing some opportunities, but I'm okay with it, right? So that is the modification I'll make. So yes, going back, we checked for level on top of level. It was a case of level on top of level. Whatever modification was required, we have made those modifications. The lower zone is not because of a gap, therefore gap rules will not apply. Now, talking about pivot and non-authenticity, it is a drop-based rally structure, which ideally we consider as a pivot or a non-authentic zone. So we should be applying the rules of pivot non-authentic, but if you go to the rule book, you will see there are some exceptions, and those exceptions are that in case of level on top of level, there is no need to apply pivot or non-authentic rules, because the positive factor we are looking for, we are already getting that positive factor being a case of level on top of level, right? So we can skip the rule of pivot and non-authenticity. Unstable equilibrium not applicable. So after applying all the applicable rules, only level on top of level was applicable. We made the modifications based on that. None of the other conditions were applied, and none of these conditions disqualified the zone. So is the zone qualified for us? The answer is yes. So now that we have a qualified zone, we can move to the next step, which is applying the boosters. So if we talk about the boosters, the first one is freshness, and we can already see that our zone is definitely fresh, gets a score of 3. Talking about strength, we do have an explosive move. That is the reason the indicator is plotting it. Otherwise, the indicator would have not plotted the zone for us. Gets a score of 2. Time at the zone, we only have 1 candle, which is again a score of 2. Reward to risk ratio will take as an assumption. Now talking about location, if I go to the monthly time frame, you can see we do have a monthly demand area, but we don't have any monthly supply. So the only solution is wherever is the most recent pivot high. Can you see that's the most recent pivot high? From there, I can divide it into equal parts, and you can see that we are planning our trade low on the curve, which is a good location to plan a long trade, right? So we are low on the curve gets a score of 1. Talking about the trend, you can see on the weekly that we are in an uptrend. So we are looking at the zone violations. So we have violation of 1 supply, we have violation of in fact 2 supplies. Why 2 supplies? Let me show you. But I think doing a replay will definitely take a lot of time. So let's do this. So we were in a downtrend. I have 10x speed, so I think it should move faster. So you can see it was too fast to understand. So what I'll do is I'll probably again go for a replay from here. And this time I'll do it manually. So you can see so when we started moving up from here, can you see we had this 1 supply which was violated, then we have another supply which was violated, and that is why the trend got converted into an uptrend, because we have 2 supply violations. All right, so in fact, you can see we also had a 3rd supply violation which happened right here. So we already have violations of 3 supplies, but in a way, just 2 supply violation make it as a confirmed uptrend for us. So we are in an uptrend, and uptrend will get a score of 1. Talking about move from the zone, we need at least 4:1 move. We already have a move which is much bigger than that, gets a score of 2. It is a case of level on top of level, and it is also a coinciding level. And the last one is trap. So if I take a horizontal line wherever my zone is, and then you see again we got some alerts. So this is how alerts they basically work. As in when you have formation of zones, it keeps updating you during the live market. So if I just start pushing it up, you can see this area has beautifully worked like a resistance in the past. In fact, you can see it's almost like a textbook example. Can you see working like resistance, working like resistance, working like support, working like support, again working like resistance. So yes, we do have a pretty clean area of support and resistance, and our zone is sitting right below it. So what is going to happen, people who believe in support would love to buy here, and their stop losses, which will be sell orders, will be placed below this area. Similarly, if we have a breakout, people who believe in breakout will also start selling. So by the time we enter this area of demand, we'll have a lot of selling coming into the market. And these people are making 2 mistakes. Mistake number 1, selling after a decline in price, which means they are selling at a cheaper price, and also selling in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So yes, that possibility is there that this can work like a trap, for which we'll again give it a score of 2. So if you talk about the overall scoring, we have a score of 10 out of 10 for quality. So I think I made a mistake somewhere, because if this cannot be 8, right? It has to be 7. Oh, trap was 1, my bad. So yes, if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio for quality, and 7 out of 8 for probability, which makes it as a high quality, high probability setup. And high quality, high probability setups can be traded as type 1 trades. So after applying the boosters, we got to know that this is gonna be a type 1 trade for us. Next, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation based on our risk management rules. Whenever the prices are back, we'll have to re-verify that does it still qualify based on our trade plan. The reason is the markets are not static, they are dynamic. Conditions are changing almost every other second. If the answer is yes, it is qualified, will place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically and rule based. And you also saw some examples which are getting carried forward for us, which we are still looking as a trade management rule. And that's how we plan trades, very mechanically and rule based. Again, if these sessions are helping you plan better trades, then do like the video. And if you are part of some trading group, or if you have any friends or family members who are into trading, you can share the link to my 100% free courses. You can share the link to these free live practical sessions. You can also share the link to the 100% free access of the demand and supply zone indicator, because I'm pretty sure all of you also understand that a lot of people are struggling with trading. So if you have these free resources available, why not to spread the word as much as possible so that more and more people can take advantage of it. And like I said, at the end of the session, I'll take your questions, queries. But before I do that, I would also like to add that one feedback which we were getting from you people was that what if I don't want to ask my questions publicly? Or what if I want to share my analysis, which is not possible in the YouTube live chat? So we have an option for one-to-one appointment. So whenever you visit our website, on the top right corner, you can see how one-to-one button. Simply click on it, and from here you can schedule an appointment. Two options available. Option 1, a voice call, wherein if you feel that you can just ask your question on the phone without sharing your screen, and you can get the answers to your queries, you can go for a voice call. And if you feel that you want to share your screen, you can also go for an online meeting, right? So those are the two options available. But otherwise, you can always put your questions in the chat box during the session, and I will help you with your questions, queries at the end of the session. So let's see what questions, queries we have. First one is from Bhanu, and the question is regarding weekly zones. I've observed probability is high. Can we have a little flexibility in probability score for weekly zones? See, definitely this is something which I always say, that the bigger the time frame, the higher the weightage. So definitely if you're looking at a weekly time frame, it has higher probability. Now, just to understand why bigger time frames, they have higher probability, just imagine we have a drop based rally structure for a minute. Let me do this. Let's say drop base rally, right? And let's assume that drop base rally only had one candle in the basing. Now, if this was a 5 minutes candle, how many orders would have executed in 5 minutes? Versus if this was a weekly chart, how many orders would have executed in a week? So there's a huge difference between the number of orders that will get executed within 5 minutes versus within a week. So what we understand is that the bigger the time frame, the chunk of those orders are also very, very big, right? So that is what makes the bigger time frame have that extra weightage. So absolutely, yes, bigger time frames, they have higher weightage, which definitely increases their probability. So yes, if you want to make some modifications to the approach based on that, those modifications can definitely be done. There is nothing wrong with it, and that is why I always keep saying that the rule book I've shared with you is a conservative approach. With your experience, you can always make modifications to it, right? And I also gave you the reason why the bigger time frames, they get a little extra weightage. All right, so I'm doing HIT. Can I use tested zones in intermediate, which sometimes result in change in trend in my favor? See, the fact is, when you are looking at the intermediate time frame, even the default setting of the indicator is to use tested areas. And the reason, I'll explain you quickly. So here you can see that we have on the intermediate time frame, all zones. In fact, I've given all zones not tested. So in fact, I think for the intermediate, it should always be taking tested. Let me just double check this. I think otherwise I need to add that option here. So we have all zones, and if I remove tested, okay, so yes, this can be changed. So we will always use tested for the intermediate. And the reason for that is, if a zone is tested, does not mean that we start ignoring it for the violation of the zone. It again has to be taken into consideration, because it might get tested twice, thrice, multiple number of times before it gets violated. So absolutely, it has to be used for tested areas, not just for fresh areas. All right, so I'm doing HIT. Can I use tested zones on HTF to get curve analysis? This is something I would not recommend, because the reason is when you are trading against very small time frames, it is always better to have as much probability in your favor as possible. So personally, I would prefer to use fresh areas for the curve analysis on the HIT. But again, like I always say, different traders, different personality styles. If you're a little on the aggressive side and you want to do it based on tested, that's your call. But I would personally recommend that always use fresh areas on the higher time frame when it comes to the HIT trades for your curve analysis. But if I'm doing HIT, can I use tested zones for level on top of level? See, again, for level on top of level, if you talk about, now let's take today's example. The lower zone was still fresh, right? Now, if the upper zone was already tested, I'm still okay with it, because the zone where I am trying to participate, that needs to be fresh. But now if I talk about an HIT trade, on a HIT trade, if I see something like this, that the upper zone is already tested, which means my intermediate time frame zone has already been tested. So that is where I would like to be a little bit more careful, because I know I'm leaning against smaller time frames. And like I was just giving example, on smaller time frames, the size of the order can also be small, which can quickly get filled, right? So that is why we need to be more conservative. So in such a scenario, I would always prefer to have a fresh area for the intermediate when it comes to level on top of level. But yes, if I'm doing a MIT trade, I might not be very much concerned about it. So again, depending upon what time frame I'm trading, HIT, I would definitely like these zones to be fresh areas. If there is a gap zone while analysis HIT at 5 minutes time frame, what to do? Do I have to apply gap rules? See, again, whenever you see a gap, if that gap is during the live market, then it has no meaning for us. But if it is an overnight gap, then you can definitely use it as a zone, and then you'll have to apply the rules for the gaps, which is it has to be fresh, it has to be a pro gap. Only then you can use those areas. But if it is a gap during a live market, then it is only because of the difference between the bid and ask, which basically shows at times even the lack of liquidity on that particular symbol. Right? So that answers this question. What should be the indicator settings for aggressive and conservative trader doing HIT trades? See, again, talking about aggressive, conservative, again, different people, different personality styles. Something which is aggressive for you might still be conservative for me. So you will have to decide. But what I'll add is that whenever you're planning an HIT trade, the more conservative you can be. So by conservative, I mean trading at the best locations, using always fresh areas, right? So all those things, they definitely would increase the probability of the HIT trades. All right. Are there any extra pointers from your experience what one should keep in mind? So like I already said, for HIT trades, always prefer to have fresh areas when you are trading the lower time frame. If it is a case of level on top of level, then the intermediate should also be fresh. Personally, when I used to do HIT trades, I will always do them at the best locations. I would not do them middle of the curve or high or low of the curve, because like I'm already saying that the smaller the time frames, the lower the weightage. So you would love to add as much probability as possible. So those are the things I used to take care of. If you are shifting to tested and low quality zones while searching for LOTL in the zone is unstable, and tested does not qualify for unstable, then also we use or not. Okay, let me try to understand this question. If you are shifting to tested and low quality zones while searching for LOTL, okay, if the zone is unstable and tested zone does not qualify for unstable, right? So if it is not qualifying, then by default it is a disqualified area, right? So you've already answered that question in your question itself, right? So you've already said if the zone does not qualify. If it does not qualify, it is not a valid zone for us. If there is no level on top of level but only coinciding, can we with that bypass pivot and authentic? See, again, a coinciding again definitely adds a little extra probability, because it is also an intermediate time frame zone. But in that case, I would prefer that my intermediate time frame zone is at least a rally based rally or a drop based drop. If the intermediate is also a structure of a pivot or an authentic zone, then again I would like to be a little bit more careful with it, right? So depending upon how the structure is on the intermediate time frame, I might not use it to add that extra probability. All right, so that takes care of the questions queries that we had for the today's session. So I'll see you now the next weekend. Till then, stay safe. Enjoy your Sunday. Take care. Bye bye.